what was going to happen, I thought, was that we were going to have to get dips that they would buy into. And we got a few dips during that period, but they never bought into it, according to the data I look at. This time, they are buying into it, right? And that's scary to me. That's scary to me. Doesn't mean the market has to crash. Doesn't mean it has to go straight down. In fact, that would be too easy in my view. I think the biggest pain would be is if the market holds for a while, a few weeks, even a couple months. Everybody feels okay again. They feel good that they bought the dip. They feel good. And then we make a new low, Then what are they going to do? They already spent their money buying the dip. Well, maybe they have some more and they'll try and buy it again. But in general, I think that it sets up for what could possibly be some pretty bad outcomes over the coming weeks and coming months and coming year.
On this episode of What the Finance podcast, I have the pleasure of welcoming back Jason Shapiro. So Jason has 30 plus years of trading experience. He's a hedge fund manager, and he's also featured in the book Unknown Market Wizards. So Jason, thanks so much for coming on the podcast.
Oh, my pleasure. Thanks for having me.
No problem. Looking forward to the conversation. We're all very busy in the last few weeks, especially after Liberation Day. But I'd be interested to hear your thoughts on what are we seeing? Have you ever seen this before? Or is this sort of just a massive own goal for the US? Or I'd be interested to hear your thoughts.
Have you ever seen this particular thing before? No, but I've certainly seen panic before. I've seen this kind of market action before. Not this particular macro thing necessarily, but this happens quite a bit, every 10 years or so or whatever. So, you just have to deal with it as best as possible. I tend to think that after being through a number of these, the best thing to do is to back off. But it's not to say there aren't opportunities to make a lot of money. There are, but I tend to back off in times like this, let things settle down, let things go back to normal, and then get back to doing what you normally do. I think this is not, in my view, normal times. So in my view, normal things are not going to work. Your levels or your technical levels or your however you do it, right, are not the thing to be doing here. This is not the time for that. There's so much uncertainty, obviously. There's always some level of uncertainty, obviously, in the markets, but clearly the uncertainty here has been ratcheted way up. So I think it's a dangerous thing. And if you're playing, that's fine, but clearly you have to play smaller. The volatility is bigger, so you got to play smaller. That's just simple math. So that's my general thought here.
Okay, interesting. And what other time periods would you compare this to from your own experience?
I mean, the things I've been through like this was, I wasn't in 87 because I was only 20 years old at that time. But you think about the Asian crisis I traded through in the late 90s was pretty insane. That was the first one I ever saw that really, I'd been through bear markets before, but that was the first time I ever saw it. It was like, whoa, what's going on? And then the reactions to it were like, whoa, what's going on? That was the first time I really saw that. And then clearly 08, was something we never really saw before. And now we have this, so.
Yeah, I guess COVID as well. It seems to be all these different. It's when they're different. It's when they're sort of unique. It's when they, I guess in the current traders' histories, as you said, most traders probably weren't around in 87. Most traders are probably the last, maybe 40 years if you're lucky. It's normally the things that are different where people freak out because they don't have any historical experience of how the market reacted. Would you agree with that?
Yes, although what I'm seeing in this particular case, what scares me a little bit, is it strikes me as being quite a bit of recency bias going on here, as they call it. Sounds like a word that somebody who wants to talk about behavioral finance will throw out there, but even the younger traders. Look, there's a lot of people out there clearly that were doing this in 2022 when we had a bear market. And I feel as though a lot of people, and I know this because a lot of people were calling me in 2022, stocks and bonds were going down in 2022. So retirement accounts that are traditionally in like a 60-40 portfolio type of thing were getting destroyed because nothing was working. And, their diversification was not doing anything except hurting them. So a lot of people freaked out and got out of the markets back then and clearly wished that they hadn't. And they've probably gotten back in since then, at least to a certain extent. And they don't want that to happen to them again. So they're not going to freak out this time. That's what it feels like to me is the situation. And I think that's dangerous because it doesn't give us, everyone's looking for that capitulation. But unless these people freak out, there's not going to be capitulation. So I feel like this could be a long drawn out bear market because of that until they do freak out. And I don't know that they're ever going to. Everybody has been conditioned to just stay in, and use these as a way to add to your long positioning. And that's what I see people doing. And that's what the data is showing people are doing. And I think that that's kind of dangerous. And I talked a lot about this in my videos and in my newsletter during the whole 2023, 2024 bull market, was that it didn't strike me that the perma bears were ever really going to chase the market higher. So we were never going to get that upside capitulation. What was going to happen, I thought, was that we were going to have to get dips that they would buy into. And we got a few dips during that period, but they never bought into it, according to the data I look at. This time, they are buying into it, right? And that's scary to me. Doesn't mean the market has to crash. Doesn't mean it has to go straight down. In fact, that would be too easy in my view. I think the biggest pain would be is if the market holds for a while, a few weeks, even a couple months. Everybody feels okay again. They feel good that they bought the dip. They feel good. And then we make a new low, Then what are they going to do? They already spent their money buying the dip. Well, maybe they have some more and they'll try and buy it again. But in general, I think that it sets up for what could possibly be some pretty bad outcomes over the coming weeks and coming months and coming year. Until we see some kind of capitulation by that, I think we could have a problem.
Okay. Yeah, that's really interesting to hear. So who's selling that? Is it sort of the professional selling, or is it just people have sold and now they're sort of looking to get back in?
I mean, the hedge funds clearly have been selling a lot because they get forced to sell, right? The risk managers go in there and say, you got to sell, right? So they're definitely selling. That's what I would say the majority of the selling is coming from. Yeah. Which, again, means that we could have a nice bounce, because if retail is in fact buying and the hedge funds stop selling, then we could get a nice bounce. We had that this morning. We'll see if it holds, but we could get that. But I think that's going to be, and it could hold for a while, and that's great. But I think longer term, that's dangerous, personally, unless people sell into it, which is another story, or unless people, really sell into it, which is another story. We'll only know as that goes on. But I think it's kind of dangerous here. And of course, if the whole world comes and says, hey, Donald Trump, you're right, let's negotiate, a trade deal so that we have no tariffs with anybody, well, then none of what I'm talking about is going to matter, because you won't be able to buy the stock market high enough at that point, because it's just going to go straight up. So that could happen too, obviously, but it seems like a low probability event. But hey, at this point, anything's possible. Anyone who I think says they know what's going to happen from here on any of that macro front and all that is kidding themselves. You get enough people with a theory about what's going to happen, somebody's going to get it right. Doesn't mean they predicted it. Like I always say, it just means they called heads, they flipped the coin, and it came up heads. It doesn't mean that they predicted it. They just happen to get a 50-50 bet right. This is not a 50-50 bet. There's so many different possible outcomes, but somebody will get it right. But anyone who sits here right now and tells me they know what's going to happen is crazy, because there's so many potential outcomes, and there is no outcome that's set in stone, because it's reflexive. One thing affects the other thing, affects the other. So the outcome is being affected by the events as they go on. So, I don't know how you can tell me what the outcome is going to be. For example, you can argue, what I mean by reflexive is, if the markets continue to go down, wouldn't we think that weakens Donald Trump's position, right, to negotiate these things, right? Versus if the markets go up, doesn't that maybe strengthen his position, right? So you can't tell me that there's not, a thing going on here where there is no definite outcome. It depends on other things that happen. There's so many inputs, right? There's so many variables that, depending on what happens with these variables, is what's going to affect the ultimate outcome, I think. So it's a very unknown time, which is clearly why we're seeing so much volatility.
Yeah, definitely. I think, as you said, there's so many players as well. There's sort of the Europeans, there's the Chinese, there's all these different massive players who are affected, and need to make decisions, and then need to negotiate with this one or this team of people in the US who then are the final arbitrators. So, as you said, there's just too many variables to actually be able to understand what's happening. And to be fair, a lot of these countries' stock market's actually going down more than the US. So that's another. So maybe that will force them to come to the table. It's probably not the best way to negotiate, but it's a.
I mean, is that how they're all deciding on things? Is what their stock market does? I mean, I don't know. I guess it is, but it's kind of a scary thought in and of itself. But, stock markets don't always go up. That's all there is to it. I'm sorry to break it to people, but they just don't. Sometimes they go down, and that's usually a healthy thing that they go down. But the European stock markets are getting hit more, because they were doing so much better coming into this too, right? So they're kind of catching up on the downside, so to speak.
Yeah, definitely. And you're sort of known as not a contrarian, but I guess contrarian is a way to look at it, but you look at sort of different things compared to what other traders are looking at. I think more sentiment and other sort of price action. Can you maybe go into that a little bit more? And I'm sure some people will be surprised that you're actually not looking to to fade this and go the other way.
I don't fade price, I fade participation. That's always been my thing, right? I don't say, hey, this thing's gone down a lot, so I'm looking to buy it. I say, hey, everyone in the world is short this thing, so I'm looking to buy it. There's a difference there. Clearly, a market going down, nothing better than a market going down to get everybody short, right? And nothing better than a market going up to get everyone long. But I haven't seen that to this point. And does that mean that I can't go up? No, it can go up. It just means it goes up without me in that situation, right? I don't catch every trade. I don't catch every market up or down. But for me to have good risk reward, I need the world to get super, super short. And while they're clearly not as long as they were a month ago, I don't see them being super, super short just yet. So therefore, I'm not fading that or being contrarian to that. I always say there's a fine line between being contrarian and just being stupid, right? In my early life, I was trying to be contrarian, price and stuff, and I got run over. This is why it's so hard to be contrarian, is if you're going to be contrarian things like price or market action, then you get run over. So I changed up what I did and did a bunch of research and looked into a bunch of data, and I am contrarian positioning rather than price, and I don't see the positioning. And I'm not just contrarian positioning. I will be, when positioning is telling me that, I will be looking to go the other way, but I still don't do that until I get market confirmation. So no matter what you do, you have to wait for the market to confirm what you're saying. And I would argue today really is the first possible confirmation that we could get a bounce. The market is acting in a way that it is sort of confirming. If you believe we're going to get a bounce here, it's starting to confirm that idea, in that the risk off assets are coming off. Bonds are down almost 3 points today, which is insane. Things like the yen are down today, which has been a beneficiary of risk off. And the stock market is rebounding in a way that I would like to see it rebound, meaning the higher beta stuff is leading it higher. So if I were looking to play for a bounce, I think today is a decent day to give it a shot, but I'm not looking to, so I'm not doing that. But for those who trade in other ways and are looking just price action and all that, then the price action is, at least for right now at 12:30 on this Monday, is starting to say that you could probably give it a shot here, and it hasn't said any of those things up until this point. So this is probably the first time that you could probably give that a shot here, in my view.
Okay, really interesting. And you said the participation isn't sort of showing what you'd want for a massive turnaround, I guess, at least, or for you to then sort of take a position. Well, what is it then? Is it sort of like 50% long, 50% short, or
pretty neutral? I mean, what's happened is open interest has gone down so much.
Okay.
Because in particular, hedge funds have just got out, so it doesn't show that they're massively short. It just shows that it's gone. The open interest has just dropped a massive amount, so people aren't playing, which means if they're going to get long, then they can build. There's a lot of that can be built up. They don't really have longs on, so if the market goes up, they could chase it and get long, and the market could go up. But it clearly also means that if it keeps going down, there's plenty of room for them to start shorting and get massively short. So that's why there's no edge for me here. I can tell you one thing: it's either going to go up or down. You know what I mean? Just like any market, right? But this, to me, just means there's no edge from a risk reward standpoint for me to be involved.
Okay.
But that's just me and my trading,
Yeah, everyone's got their own strategy. Is this something that you're seeing happening more often? It does seem like there's these extremely violent moves that, during COVID and now and other periods where there's just extreme downside. Is this recency bias of me thinking this, or is this something that you've seen change?
It happens all the time. I mean, 10-15% drawdowns in the stock market or whatever, 20%, they happen. They happen all the time. I can go through dozens of examples. The LTCM thing in the 90s, the Asian crisis, the popping of the .com bubble after 2000. That was a big bear market. 08, I mean, it was only 7 years later or whatever, 22, was a pretty big down move. These things happen all the time. Believe it or not, they happen all the time. Believe it or not, the stock market is not a guarantee. So it's pretty normal, Like I say, the macro environment here clearly is not what I would call normal. And the action, the volatility is clearly not normal right now. But this happens. It happens all the time, man,
Yeah, it's one of those things that I guess it hasn't happened as much recently. So probably or people, as you said, people get used to things always go up in a slow and steady pace, and then they forget about these sort of aggressive downsides.
Everything gets forgotten about in a bull market. And then we get reminded. That's how the game's played. That's how the market, that's what it is. It giveth and it taketh away, and it usually taketh away a lot quicker than it giveth, is what I would say. And that's the point we're at here, so how much does it take away and how much pain, blah, 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 we can only let the tape tell us. It's very hard to predict. And I think, like I say, that today is the first day that we're seeing a much better tape. I mean, the S&P is down still 50-something points, but it's halfway through the day. I think the tape is acting, for the first time during this, it's acting better for the first time.
Okay. And so obviously we're talking a lot about stocks. Are there sort of any other markets that you're seeing and watching, or it does seem like there's quite a lot of correlation between a lot, commodities and everything
There
else.
is. I mean, the trade that I have had on and I still have on is a short yen trade. It hasn't done me any good, but that was the most crowded trade. The one trade that I saw was massively crowded, and the yen is most likely going to go up if the stock market goes down. So if the stock market continues down, I'm most likely going to lose money on that trade. But I think as a way to play, if risk assets do go back up and stocks do go back up, I think the yen, and I've been saying it since I put this on a month ago, I think the yen is the best way to play that from a risk reward perspective. And that's kind of proved out because I got short yen like the second week of March. And if it had gone through on a closing basis, the high of when I got in, I would be stopped out, and I'm not stopped out. So that means the yen hasn't really gone up since then, whereas clearly the stock market has gone down a lot, right? So you haven't lost any money shorting the yen in that period, whereas buying stocks in that period, you would have lost a lot of money, right? So I continue to think that the yen, short yen, is the best way to play for a rebound in these assets. I would have been arguing that short bonds is the same. And today is sort of the confirmation of that, because the bonds are getting crushed in the face of the stock market even giving a hint of a rebound. So, this is what sort of market confirmation to me is all about, right? There's better ways to get long risk assets here than buying stocks based on A, the positioning of the stuff, and B, the market action of stuff. We didn't have the market action in bonds until today. We have had the market action in yen for a month. Like I say, I'm not even stopped at a yen yet. And that's with the stock market essentially crashing. So that's good market action to me. If the stock market crashes again, is the yen going to hold? Probably not. I'll probably get stopped out there, right? But, it's acting much, much better, is my point, than getting long stock. So I think that's the key to finding, and I talk about this on my videos almost on a daily basis on YouTube, but I think that's the key to finding the best risk reward, a combination of the positioning and the market action. That's really where you want to be.
And it sounds like it took you quite a long time to sort of learn that, to grow into this and to learn this.
A long time and a lot of money. These are expensive lessons, but I'm trying to help people. And I always say this. I do things and I do videos, but you can lead them to water, but you can't make them drink. Most people, including myself, have to learn through their own experience, right? Who the hell is going to want to learn through Jason Shapiro? I mean, look at me, right? Who's going to want to learn through this scruffy guy wearing a Guns N' Roses t-shirt? You know what I mean? You're not going to want to listen to me. You're going to want to learn through your own experience. I will still put it out there because I think that even if they're not going to listen, people aren't going to necessarily listen to what I say immediately. Something will happen, and it will click, and they'll be like, "This is exactly what that scrub was talking about, right? This is what he was talking about, and this is what happened to me. Maybe he may know something, and maybe I could maybe start to listen to what he's saying." All of the things that I talk about come through my experience. I blew out more than once, and finally came to the conclusion that I have to stop doing that. And how am I going to stop doing that? And then I went to work and did a lot of work trying to figure out how I was going to stop doing that. And I try to pass those lessons at this point along to people, whether they listen or not. I wouldn't have listened, like most people. I have a tendency to not listen to people and have to learn the lessons the hard way, as most of us do. I think it's a natural process of learning. It's actually a natural process of growing up. We don't listen to our dad, because we're trying to break away from our dad. I go back now, and my dad passed away quite a while ago, but if I had listened to the things that he had said, my life would have been a hell of a lot easier. And I now look at my son, and it's the same thing. If he had listened to the things that I say, his life would be a lot easier. But he's not going to. Just like I didn't listen to my dad, he ain't going to listen to me. It's just a natural process of learning. But eventually, hopefully you get it. So yes, it took me a long time. But at least to this point, I got there,
Yeah, and that's the main thing. Just hopefully it happens earlier than later. But it's as you say, you have to learn these lessons yourself and get kicked in the face a few times until you realize, like, hang on, I actually need to put the time and effort in and listen to people.
That's really the only way, I think. Not the only way, but the way that most people are going to learn is to learn via their own experiences. But like I said, I'm hoping that I can at least. I acknowledge the fact that no one's going to look at myself and be like, oh my God, yes, I'm going to do everything he says. Nor should they, by the way. Not everything I say is right, but I'm hoping they can at least help them speed up their learning curve as they go through this.
And what are the largest, I guess, or the biggest mistakes you see people make when they're sort of get into trading, or even experienced traders?
Trade too big, trade too much. Those are big ones, Fight the tape. Think that they're going to be able to predict the future, Think that they are right and the market is wrong, These are all classic mistakes. And the problem with all of them is sometimes in doing that stuff, you are right. And one book I read years ago used to call that faulty learning, right? So here you go. I'm going to fight the tape because I think the market's wrong and I'm right. And oh my God, it worked. Aren't I a genius? Well, over time, that's not going to work. It might have worked this one time, right? But over time, that's going to kill you. I promise you. In particular, fighting the tape, right? So I think that's a big one. Annie Duke, who I once interviewed on my YouTube channel, talks about that a lot. Outcome. The outcome, whatever it may be, doesn't necessarily mean that the decision was correct. Sometimes you can make a correct decision, but have a bad outcome just by randomness or bad luck or whatever, right? And sometimes you can actually make a bad decision and have a good outcome by randomness or bad luck. But over time, that's not going to work. Over time, it's making good decisions all the time, or as much as you can. That's going to work for you over time. And avoiding bad decisions over time is what's going to work for you over time. But like she says, on any one given occasion, a bad decision can have a good outcome, or a good decision can have a bad outcome. So, and that makes it very hard, that makes it very hard to try and focus on just making the good decisions,
How do you know if it's a bad decision? Is it sort of like quite obvious? Because I imagine, yeah, as you say, if you keep getting this confirmation bias, it's
yes,
working.
There are rules. If you go and read things like, I'm not pushing the book that I was in, but if you go and read the first 3 Market Wizards books, I always say, which I was not in, you can pick up what the rules are. There actually are rules to this game, right? Don't overtrade. Don't fight the tape. Things like that. Those are the rules that these people who have had incredible amounts of success. You're talking about Paul Tudor Jones. You know what I mean? You're talking about Bruce Kovner. You're talking, in Market Wizards, the first one. You're talking about some of the greatest traders that have ever lived. And they're saying in those books, what the rules are. So you want to stick to those type of rules as much as possible. That's what the good decision, bad decision is, right? You have to know what a good decision and a bad decision is before you can make them. Well, those are all laid out in books like that. So that's, to me, at least in this situation of trading, how you know what's a good decision or a bad decision. Like I say, you're going to make good decisions and have losing trades. Doesn't mean it wasn't a good decision, right? And there are times where you could make a bad decision and have a winning trade. Doesn't mean that it was a good decision. it's over time that this matters. Any one trade can work anytime. I can flip a coin right now and say if it's heads, I'll get long. If it's tails, I'll get short. Okay, heads, I'll get long. Okay, I buy it. It went up. I sold it. I made some money. Was that a good decision necessarily? Over time, probably not. This one particular time, maybe, but over time, probably not. So I think that's really the key to anything, but including trading.
Yeah, it's a great message. So what would make you change your strategy? So I know it's worked historically, but is there anything where, say, if it's what would you see and be like, okay, this isn't working anymore?
I monitor my statistics pretty closely. And if my statistics started to fall outside of the expectations of those statistics, and the good thing for me at this point, obviously, is okay, you can back test something and know the statistics, but I've been trading this process now since 2020. I'm sorry, since 2000. So I'm going on my 25th year of trading this process. So I have real statistics going back 24 years. So I can use those as my framework and make sure that the return stream, both the returns and the drawdowns, are falling within those expectations. If they start to fall outside of those expectations, then I got to start questioning if what I do still works. And if it doesn't, then I would have to think about changing my strategy. Now, quite frankly, at 57 years old, about to be 58 years old, I ain't going to change anything. If my returns go to shit, then I will have discussions with my clients and say this stuff ain't working and I'm going to retire. That would be my thing. I've been doing this long enough and I'm old enough that I don't think that I would necessarily be making big changes to what I do. I would probably just say, this don't work no more, man. It worked. We had a good run. It worked for 25 years or 24 years. We had a great run, and now it's been arbitraged out of the market or whatever. It's been found out, whatever, and so I'm done. You can catch me, on the beach or whatever. But for other people, I think that's the thing. You have to have some kind of framework for what your expectations are, both a return, a volatility, and a drawdown framework. And if you start falling outside of those expectations, then you got to start questioning as to whether your process is actually working.
Yeah, great point. And I guess, people don't normally change, or human nature doesn't normally change. So that's something that you are able to, I guess your strategy seems to be focused around human nature.
That's what my strategy is definitely focused around, yes. Look, it's focused around the very basic idea of like, here I am as a 20-something-year-old kid trading, and I made some money sometimes, but over time I lost money. So if that's true, then if I had done the opposite, obviously, of everything, then I would have made money. So it's focused around that very idea. And since I am no smarter or dumber than the vast majority of people in there, I fit within the normal distribution just like anybody else. If we're all going to suffer that same fate, then I think the odds go up of my success if we are all doing the same thing. And over time, that loses money. Then if we're all doing it, then the odds probably increase that we're going to lose money. So why not just do the opposite of that and make the money instead of losing the money? That's really what the general idea of what my strategy is based around. And we know that, over 95% of people who try this lose money. So if I could fade them all, then I could capture all that money. I don't know what they're all doing. But when I start to look at positioning data and all that, I can get a pretty good glimpse of what the vast majority of them are doing. So therefore, it increases my odds, hopefully, that will, taking the opposite side, works. Nothing to do with me being able to predict the future of the market. This has nothing to do. I could sit here and talk macro all day with you, right? We want to talk about the tariff situation. I could sit here for 2 hours and talk about it. I find it very fascinating. I happen to like macroeconomics very much. I think it's incredibly fascinating, but none of it, zero, has to do with how I actually trade. Zero.
Yep, no, makes a lot of sense. And I know you sort of focus as well on when the news, so when really bad news doesn't, the market doesn't react negatively, it sort of reacts positively. So is that something that you're seeing? It does seem like today it's sort of reacting reasonably positively, despite there being extremely negative news, or it's just less
Well, I mean, it's
less
not
bad.
even 1 o'clock. You know what I mean?
Yeah, okay, time.
Oh, the Dow is down 900 points. I mean, this is the one that's kind of making me laugh a little bit so far today. Everyone's like, "Oh, this market is doing so much better than you would have thought." The Dow's down 900 points. You know what I mean? Like, I know that doesn't seem like a lot anymore because of what's gone on the last few days, but what was the last time before last week that we saw a Dow down 900 points? So I don't know that it's necessarily acting that much better, you know, to this point. But I hear what you're saying. But yes, like my whole thing with market confirmation is that I always say, don't do anything. I don't care how you trade. You can't take a trade until the market confirms your view. That's how it confirms my view. My view is everybody is short here because the news has been nothing but negative. Everybody is shorting because of that. Okay, so I want to get long. Well, when am I going to get long? I need the market to confirm it first. Well, the confirm is, hey, more bad news came out along the lines of what everybody has been shorting about, and the market didn't go down anymore. Okay, that's the market confirming to me that, okay, I can buy it now. Does it always work? No. But does it increase the risk-adjusted return of the idea, the risk-reward of the idea? Yes. And over time, that will work. So that's what that thing is all about. Yeah, you know, the market's doing better than expected, and so therefore, you know, I'll look to take a trade. This news failure type of idea. That's how I do market confirmation because that fits my process. How other people do it, you know, if you're a technical person and you're trading charts or whatever, okay, how do you say that the market's confirming? Well, I trade breakouts. Well, the market just made a new high. You know, that's a breakout. It's confirming my idea that we're breaking out here. Okay, go with it, you know, and if it fails on the breakout, then get out of it and cut out of the trade and wait for the next breakout, you know. However you trade, there has to be some way that the market confirms that what you're saying is correct.
Yeah, great point. So, Jason, thanks so much for your time today. We sort of touched on a lot of different important lessons and what's happening in the world. But my last question is, what is one message you want people to take away from our conversation?
One message to take away. We're talking to people that are trying to trade the markets here.
Yep, traders, anyone who's in macro and has been interested in getting back into the market, or they think it could be a turnaround, or yeah, just anyone in general.
Don't try to outsmart. You know, I think that's the message. Don't try to outsmart this stuff because you will lose over time. You know, I always like to say, like, there may be one person out there, and it's probably you out there, who is the single smartest person out there. But that's not enough because you have to be smarter than everybody in the market combined, because that's what the price is. It's everybody's opinion in the world combined to price. So you have to be smarter than all of them combined if what you're going to try and do is outsmart the market. I think we can all agree nobody's that smart. So don't try to outsmart it. Let it tell you. I don't care what your view is. I don't care what your process is. You want to trade you want to trade macro? Okay, here's my macro view. I think that the world is going to come around to what Donald Trump is saying here on tariffs, or I think that Donald Trump is going to have to back down. So therefore, I think the market is going to rip higher from here. Great. But let the market tell you first before you do that. Because truthfully, if that's true, and you're right on that, then the market has a hell of a lot higher to go than this, right? If what we just said is true and this whole thing turns around, the market's going a hell of a lot higher. So why try to bottom ticket? Let the market tell you when is the right time to do that. The market will tell you. The vast majority of the time, the market will tell you when that's right. By confirming your thoughts, right? So that would be my main message. Don't fight it. You know what I mean? Don't think you're smarter than it, because that over time is going to kill you. And don't be fooled by the one time where you happen to think you're smarter than it and you do it and it works. don't be fooled by that either. That's fooled by randomness, so to speak. So, don't fight it, and don't think that you're smarter than everybody, because you're not.
Yeah, that's one of those times where you do something that's not right, and then you get rewarded for it. So that's exactly what I was going to say.
That's right.
Great. So Jason, thanks so much. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Well, we have a webpage, crowdedmarketreport.com. We're on Twitter. We're on YouTube. I would go to YouTube personally, because we try to do these videos. I do them at the end of every day, which may not be that exciting on every single day, but I find that over time, I try to talk about a lot of the lessons that I'm saying here, and I try to point them out. Look, this is exactly what happened. This is what I'm talking about, right? And this is what happened today. Here's the example. Like, it's live time examples, right? Rather than just a bunch of, hey, this is what I think kind of thing. Well, here's the example, right? So we do that on YouTube. I do weekly videos on YouTube that are free, talking about some of these things. We have a really, I think, funny one this week, if people want to check it out, because we do for our members on Friday night, we do conversations about the COT data that just came out. And then on Sunday night, we also do conversations about, hey, here's the market this week, and here's what we're looking at, and da-da-da-da-da. And those are usually for members only. But this week, for whatever reason, the Friday night one, I think a lot of people, people love when I get all fired up and I get all ranty, so to speak. And on Friday night, I got pretty ranty. So my partner ended up just taking that conversation and putting that on YouTube this weekend on Sunday. And from the feedback, people seem to like that one. So, and that's all free. So I think this one was called here, Market Meltdown, Can We Bounce Back? Right. But you can go on our YouTube thing and the Crowded Market Report on YouTube, and there's hundreds of videos on there. We do interviews with people like Larry Williams and Peter Brandt and Linda Ratchke. I have pretty good access to some pretty good people because I've been around for a long time. And I try to mix it up. We do a bunch of weird little things that we try to fill up the time with every weekend. Sometimes it's about, hey, I very rarely talk about here's the specific market right now on that, because my view isn't really no better than anybody else's. But I try to do very little of that. That's really more kept for the members type of thing in the weekly newsletter anyway. But I try to get into, I'll do lessons, that I see, or we'll interview some people that are on our Discord who have cool stories about their trading that a lot of people I think can relate to. We'll do stuff like that. We'll do stuff like look at portfolios from the beginning of the year and see how they're doing relative to the market, just to make the point. Last year we did we showed 4 portfolios, one of them being the Barron's Roundtable, underperformed the S&P by 24% last year. So I'm trying to make the point, these are the smart of the smart, supposedly, right? The Barron's Roundtable is supposed to be the fundamental best of the best. They underperformed, and it was a long-only portfolio, underperformed the S&P by 24% last year, right? So I tried to do videos like that, and I didn't know. We didn't do that on December 24th. We did that on January 1st. Well, it was probably January 15th by the time the Barron's Roundtable came out. But here's the Barron's Roundtable portfolio, and we did a couple other ones too. Let's track them over the course of the year and see how they do, right? And that's how it ended up doing. Every one of the portfolios underperformed the S&P, and Barron's did the worst. The other ones were basically random portfolios, So the random did much better than those guys, and those guys did the worst. So, we do stuff like that to try and make the point of, if you think you're going to, these are people that manage billions of dollars and have 100 analysts working for them, and they all went to, Wharton or whatever, and got their MBAs. And how did they do? So if you think, this is really the main lesson I'm trying to get across. If you think that that's how they did, how are you going to do better thinking, because those people don't let the market tell them what to do. They have been trained to believe that they are better than that they can beat the market because they got their MBAs and they can do all their spreadsheets and all that stuff. And the truth is, the proof is in the pudding. They can't. So just something that it's like food for thought, right? If they can't, then how are you going to? So think about the market in other terms, because those terms clearly are not working. So yeah, you can check us out there too. That's all. Most of that is free. I think, if I'm not mistaken, the daily video that I do, it costs like $10 a month or something. But we do one free one a week, usually on Thursday night, or if there's a day that things go kind of crazy, we'll do it then. But there's a lot of stuff, a lot of free stuff there.
But yeah, thanks so much. I really enjoy your sort of free videos. So I'll have to sign up one day and watch the rest of them. But Jason, thanks again for coming on. Yeah, I look forward to doing this again in 6 months and seeing what's happening then.
Absolutely, man.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.